Hello, landlords. You're not content with just owning half the housing stock. You've now officially taken over companies' house too. Yes, buy-to-let companies are now the single biggest business type in the UK. Somewhere, a tax accountant is popping champagne. Now, should you join the trend and stick your rental properties into a limited company? Or is this just another way to drown in paperwork while HMRC lurks in the shadows, waiting to take their cut? Let's break it down. Starting with the pros, aka why landlords love limited companies. Tax savings, baby. Remember the good old days when you could deduct all your mortgage interest from your rental income? Yeah, the government killed that for individual landlords, but companies still get the perk. Lower corporation tax, income tax for individuals, up to 45%. Corporation tax, a mere 25%. If tax bills were horror movies, that's the difference between The Exorcist and Scooby-Doo. Scaling up like a boss. If you're planning to go full monopoly mode and build a property empire, limited companies make reinvesting profits much easier. Banks also love lending to companies that actually look like businesses. Who knew? Inheritance tax planning. Want to pass your portfolio down without your kids selling a kidney to cover the tax bill? A company can make succession planning much smoother, though, let's be honest, they'll probably just sell your rentals and buy crypto. Now the cons, aka why HMRC always gets you eventually. Higher mortgage rates. Lenders see a limited company and think, aha, a chance to charge more interest. Limited company mortgages tend to be pricier than personal ones. So if you're dreaming of bargain rates, prepare for disappointment. Accountants will love you and invoice you accordingly. Running a company isn't free. There's admin, legal fees, and accountants who charge £200 an hour to tell you that you forgot to file your annual return. Want to transfer property? Hope you like paying taxes? Already own property in your name and want to move it into a company? Great. Just be ready for stamp duty and capital gains tax, because obviously, the government couldn't let you get away with a tax loophole that easily. Getting the money out is complicated, so you've saved tax in the company. Fantastic. Now, how do you actually pay yourself? Salary, dividends, random expenses that are definitely business related. Whatever you choose, there's still tax involved, because of course there is. So, should you do it? Well, if you're a serious investor with a growing portfolio, a limited company could be a smart move if the numbers work. But if you only own 1 or 2 properties and just want to make some passive income without HMRC breathing down your neck, the extra hassle might not be worth it. The moral of the story? Do the maths before you follow the herd. And if you want expert advice from someone who actually knows what they're talking about, well, you know where to find me.